My name is Andile Shanti, the latest member of the Best of Breed team, and I'm joined today by Omri. Omri manages our Opportunity Fund, and I'll just like to hand over to him.
Thank you, Andile. Good morning, and thank you for joining. What I want to discuss today is structuring a portfolio in an uncertain world. I think, as you know, historically we've tried to use different instruments to look for different environments. So just looking at the current environment. So I think the one big surprise has been the massive rise that we've seen in inflation. Now I've graphed here on the left-hand side the US inflation numbers, and that's from the start of 1992. So the last 30 years actually. And you can see this, it's the highest inflation has been. And yet, if you look at it on the right-hand side, the kick-up in the US bond yields have been very muted. So we've seen a lot of pain taken by investors in US treasuries and US long bonds. But I mean, if you look at the real rates, it's a huge negative real rate. So either inflation has to start coming down quickly, or we're going to see further pressure on the US long bonds. I mean, similarly in South Africa, we've seen inflation rising, but much more muted than internationally. So the question here is that the end of our inflationary cycle, or are we still on that way up and we still need to see that inflationary pressure flow through? Similarly, we've seen our interest rates now increasing quite a bit. And on the right-hand side, I've also included, excuse me, what the market's expectations are of interest rate increases. So we've seen about a 75 basis point increase, and the market is discounting another 275 basis point increase. So significant rate increases, which will put pressure on the economy and on the consumer. In addition to that, we know what's happened to fuel prices, to food prices. So we think we're moving into an environment where the SA consumer is under quite a bit of pressure. So just looking quickly at the Opportunity Fund's performance, we've been very pleased with the fund's performance over the last couple of periods. I mean, we've highlighted here 3 months, 1 year, 3 years, and 5 years. And it's very pleasing to see that over all those terms, we've outperformed the average medium equity fund. And we've tried to keep up or try to capture some of that upside of the market. So I mean, if you look at the 3-year number, the Opportunity Fund did about 11%, whereas the market did 14%. So managed to capture quite a bit of that. But I think one of the other objectives is to try and beat inflation plus 5. And this is just a graph highlighting the returns since inception. And you can see that orange dotted line is inflation plus 5. So it's very pleasing to see that since inception, there were periods where we've battled to keep up, but since inception, we've actually managed to outperform that. And it also places us in the top decile of funds in the category. Just looking at what's driven performance, and that's over the last quarter. So there was a very strong run in the coal prices, and we bought some Thungela that came out of the spin out from Anglos. And even though it was only 1.5% average weight, it contributed 1.2% to performance. British American Tobacco, a long-standing favorite of the fund, contributed 0.9%. Another small holding, Merafe Resources, contributed 0.5%. And then our banking holdings also contributed to performance. What's been the big drag has been Naspers. It's very disappointing. It's a company that you know that we've always favored. And what's happened over the last 12, 18 months is the regulatory risk surrounding tech investments in China has increased significantly. So despite Naspers falling as much, we haven't used the opportunity to increase our holding because the forecast risk has increased. What has helped is that we've had hedges over Naspers, so we haven't borne the full brunt of the sell-off, but it still had quite a big negative impact on the fund. You'll see the other detractors are all dollar-linked investments. So with the rand strengthening, any foreign currency exposed investment also took that pain. So if you look at the performance, that must be taken into account, the huge drag that Naspers was on performance. And if I go back over the last year, the fund at 18%, despite one of its biggest holdings, Naspers, doing as badly as it has. So just looking at the current outlook, as I said, record use inflation, and that's driving synchronized global monetary tightening. It's not only the US, we're seeing interest rate increases across the world. US real growth negative as inflation keeps on pushing up. There are a lot of supply chain disruptions caused by the Russian war, also by the Chinese lockdowns more recently. Locally, we expect further rate hikes. We still see select value in some SA equities, even though inflation has increased and interest rates are increasing. We still see attractive real returns from our long bonds. And for that reason, we haven't seen the sell-off that we've seen in US Treasuries as well. Recently, foreign exchange has relaxed, enhancing our ability to swap local asset for quality offshore assets. So, I mean, if you can, as an example, you can buy the old SAB locally, ABI InBev, or you can buy Heineken overseas. So with this relaxation, you can swap like-for-like assets and hopefully increase the quality of the portfolio. And I think we also expect the market volatility to increase because on the back of the monetary tightening. So looking at the different asset classes and our view on the value of them, we still see value in SA bonds. In hybrids, we still find opportunities, so structured notes and convertible debentures and the likes. SA equities, selectively, we still see value. In the fair bucket, you'll see that SA property is now there, where about 6 or 9 months ago, it was in the attractive bucket. We've seen quite a rally in SA property, and that's now moved to the fair bucket. Developed market equities, ex-US, still in the fair bucket, SA inflation linkers, and US equities, is actually in the expensive bucket, not in the fair bucket. Developed market bonds, credit, and cash, also expensive. So looking at the fund positioning, and you'll notice that there are quite some changes since the last time we spoke. We spoke in January. Since then, the SA equity weighting has dropped from 51% to 41%. So we've reduced that by 10%, and we've taken advantage in the rally in risk assets to reduce our weighting to risk assets. Bonds have increased slightly. Opportunistically, we've added to that. And you'll see that the sell-off in equities have mostly been taken up by an increase in our cash holdings. And that increase in cash holdings give us the optionality in market volatility to trade, to buy some of the long-term quality shares that sell off, or other opportunities that emerge. I think the only other notable thing to note is that you'll see that the property still at about 5%. So we have it's grown because of a rally in the property prices, and we have selectively taken some profits there as well. So in summary, we've lowered our SA equity position. We maintain a high bond exposure due to the attractive real returns that we can get. We maintain high hybrid exposure, so an exposure to structured notes, it's just over 5% of our portfolio. Currently, that basket of notes deeply in the money, and we expect an internal rate of return of over 20% from that part of the portfolio. So we've got the high cash holdings providing us that optionality. We've also got cash alternatives in the portfolio where there are companies that are under buyout offer that is almost a cash-like return. In addition, we do expect the Steinhoff claim to pay out in the next quarter. And as you remember, Steinhoff was quite a big holding the end of 2017. So that should provide a nice kicker to performance once that claim pays out. Currently, that claim is valued at 0 in the fund because we don't know the exact amount that we're going to get. So that should provide a bit of a, as I said, a kicker. So in terms of FX exposure, we know that the regulations have relaxed so that we can take it up to 45%. We think in a medium equity fund, that could be quite risky. You're exposing yourself to one macro factor. But in addition to our foreign assets, we've also got currency overlays taking our exposure to about 27%. And as I said, market volatility, we expect to increase, and that provides opportunities to reposition the portfolio. So just in conclusion, I think we're moving from a low declining rate environment into an increasing rate environment. So we've been the beneficiaries of a monetary dividend where we've seen constant monetary and fiscal stimulus and interest rates decreasing, and we think that tide is now turning. We are moving into an increasing interest rate cycle. So all those tailwinds that's helped now turning to headwinds, which will make it a bit more difficult. So we expect more volatility as the market digests this new paradigm. In addition, we think US equity valuations are high, especially long duration growth assets. And we've already seen quite a sell-off in some of those assets, but they are discounting a future growth at very low rates. And as your risk-free rate increases, the valuation of those assets also becomes lower. In SA, we find select value, and SA could be a beneficiary of crowding out of developed markets and in search of yield. So we've still got equities offering you very attractive dividend yields with okayish growth. And that could be, as foreigners exited our equity market a couple of years ago in search of yield, they could come back to our market. SA bonds offering attractive real and nominal returns, so we've maintained a high weighting to that. So we think the Opportunity Fund has a nice mix of capital protected instruments offering decent yields. It's got a high weighting to bonds, giving you a nice supporting yield to the portfolio. And we've got exposure to attractively valued local businesses. We've also got hedges on some of our big positions, and we've also used the equity market strength to reduce our weighting to risk assets and to increase the cash optionality. Thank you. I hand over to Andile for questions.
Omri, that was amazing. That was nice and concise.
Thank you.
I do have a couple of questions for you, but
Yes.
because it was a long weekend, I'll just ask the easier ones.
Okay, thank you. That's kind of
So, Omri, I've noticed that over the last year, you've increased your bond exposure.
Yes.
So taken at face value, right, increasing one's bond and duration exposure in an increasing interest rate climate
Yes.
is counterintuitive. So what was your thinking behind that?
That's a very good question, because I mean, as you rightly point out, interest rates have increased, and we expect further interest rate increases. I think the starting point where we started from in terms of our rates, our short rates relative to our long bond rates, there was a huge gap. So the spread was very wide. And you could get a very good or positive real return from the long bonds. Even with the current interest rate increases, that situation hasn't changed. You're still getting a decent real return. And as interest rates increase, that decreases the pressure on inflation going forward. And long bonds are typically worried about the inflationary outlook. So as interest rates increase, your inflation expectations lower, and that's normally positive for your long bonds. So it's perversely, we think long bonds, even in this increasing interest rate environment, could actually do reasonably well, and that's why we've retained our high weighting. I think further support for our bond holding is that South Africa's fiscal position is much better than what was feared and anticipated, also decreasing the pressure on issuing new bonds. Foreigners have exited South African bonds, and again, a search of yield South Africa screens very attractively on a global basis in terms of real returns.
True. Omri, the audience has come in with a number of questions,
Yes.
and I see the Naspers and Process one is one that I have to ask, unfortunately. So you currently have about 6.5 combined in Naspers and Process.
Yes.
And one of the audience members would like to ask the following. So given the price volatility over the last year and a bit, and the unpredictability of the Chinese regulator,
Yes.
how is Naspers and Process done in the fund, and what is your view and your investment thesis going forward on these two stocks?
So Naspers and Process hasn't done well in the fund at all. We've been fortunate, or it's been by design. We've had hedges on Naspers and Process, so a portion of that fall the fund got protected against that. And even now, we've got hedges on both Naspers and Process, so that should continue to hedge some of that downside. But what is our current outlook? So in our view, the long-term potential value remains in Tencent. Okay. But the forecast risk associated with it has increased significantly. So that's why we haven't used the opportunity into the sell-off to increase our holding.
Okay.
We think on a risk-adjusted basis that doesn't make sense. But Naspers continues to trade at a significant discount to its net asset value. So if we see some reprieve from a regulatory point of view, or some certainty emerging in markets like certainty, we will see a return to Tencent, and we do still think there's a lot of optionality within Tencent. So we think our current weighting is suited to on a risk-adjusted basis.
Thanks for that. There you have it, folks. Omri, we do have some time for one last question. Yes. I see the last question here I have from the audience again. They really are pumping these questions, is on property. So someone says here, you've been quite active in your local property allocation over the couple of years. Have you been looking at offshore property?
We've been reluctant to look at offshore property. Offshore property yields are also quite a bit lower than local property yields. And I won't really say we're an expert on global property. So unless we find a specific opportunity that we've done the research on, I think we'll then look at it. But at the moment, we've got very little offshore property exposure.
Omri, thank you so much. I love your honesty in that last response, and thank you for coming today.
Thank you, Andile.
Yes.